Hello, good afternoon. You've tuned into MF Corner on CNBC-TV18. I'm Vinny Motiwala. Thank you so much for tuning in as always. Now today what we're going to be doing is we're going to be taking all those mutual fund related queries that you all have sent us. Given that there's so much uncertainty happening around your portfolio, how are you all looking at that? What are the changes maybe that you all need to make? We have our experts joining in with us to help you all with just that. We have Prableen Bajpai, founder of FinFix Research and Analytics, joining in with us, as well as Nirav R. Karkera, head of research at Fisdom, to answer all your mutual fund related queries. Prableen as well as Nirav, good afternoon and thank you so much for joining in with us. Now let's just get started with the queries for today. The first query for today we have is coming from Gautam, writing to us from Mumbai. He wants to know the best way to buy silver and copper in mutual funds. Prableen, that interest for commodity side has really picked up pace now. What is your view coming in on this one, and how should they be looking at investing here through mutual funds?
Definitely mutual funds is one of the best ways if you want to take exposure to any of the precious metals. But sadly, Vinny, at this point, we only have two available options, which is gold and silver. In fact, till 2021, there was no silver ETF as well. Only in last of 2021, SEBI approved silver ETF, and 2022 January, we saw ICICI came up with the first product, which was the ETF NFO, which came up. So if Gautam is looking to invest, of course, a silver ETF or FOF, if he wants to do an SIP, is, I think, one of the seamless and best ways to take exposure. Over the last 3 years, silver has delivered roughly 19.5% returns. In the last 1 year, about 17.5. In the last 6 months, of course, it's gone up by 20%. So like you said, Vinny, that the interest has definitely gone up, but I would say that silver should be taken as a more tactical call rather than part of the core portfolio. Probably gold is more suited for that. But for gold and silver, both which are currently available for investors, I think they must be wary of the recency bias because of the great movement which we've seen in these metals. And currently, copper is not available. And just to give a word of caution that during this period, since the first ETF was launched, silver ETF in itself, or the FOF, they've seen a fall of roughly 28% was one of the falls, which was March to September 2022. Likewise, 16% fall in 2024. It's gone through. So even in this short time period, 3.5 years period, there have been falls. So whosoever is investing, I would say that taking exposure in tranches through an SIP model would be most ideal.
Okay. Thanks for the view coming in there. Let's move on to the next query. We have Shanmukh, who's writing to us from Hyderabad. He has invested in Axis Long-Term Equity Tax Saver ELSS scheme and Aditya Birla Sun Life ELSS scheme as well. He wants to know if he should continue the SIP or switch to systematic withdrawal plan. Nirav, what's your view coming in here, right? Given that, if you're now attempting for the new regimes or the change in taxes that you're seeing, how much sense does it make to still continue with this ELSS plan for them? And what should they continue this SIP or maybe just move to a systematic withdrawal plan?
So it's a common dilemma that most investors have been speaking to us about. And the beauty about ELSS is that the benefits are three-faceted. The most commonly known dimension is the tax-saving dimension, which may not be applicable to those choosing the new tax regime. However, there are two more benefits of investing in an ELSS fund. Of course, the funds that Shanmukh has picked are pretty decent funds. They have a good track record, and it has been able to perform consistently, even on a risk-adjusted basis, right? So the other two benefits that I was speaking about, and which builds the case for Shanmukh to continue his SIPs. One is the discipline it enforces. So if you're a long-term investor, but you're not really sure about your own discipline and commitment to investing, the 3-year lock-in holds you in really good stead. And the SIP ensures that every tranche or every investment stays for at least 3 years. So that way you experience some part of the compounding effect. So that's the second dimension. The third important dimension of ELSS funds is that the lock-in also gives the fund manager the visibility for how long does he have the funds for, right? So this, in fact, enables the fund manager to deploy and invest much more effectively without bothering about holding on to some cash to manage redemption flows, right? So the certainty of timeline for which the fund is available and available to be deployed ensures that it is put to much more effective use than most other open-ended mandates.
Okay, Prableen, your view coming in on here, both these funds that they are holding as well, Access long-term ELSS as well as Aditya Birla Sun Life also tax saver ELSS scheme. What are your thoughts here? SIP or switch to SWP?
So definitely, Winnie, that equity exposure is so important as part of your long-term portfolio. So if these are the only holdings he has, and even if he's looking to withdraw or move out, he must start something in equities. Within the category, Axis and ABSL have not been amongst the toppers. They've been okay in terms of their performance on rolling return basis as well as SIP returns. If we see amongst 5 and 7 years, they are in the sort of lower end of the curve where the returns aren't that great. But if if this was a choice over and above a fixed income product, he was still smart to take exposure to ELSS because, of course, with equity taxation, the benefits that it's giving, he's still better off. But if he's looking to continue in ELSS, I feel that there are better options available given the highest and the lowest returns on 5 and 7 year return basis. Also, I would say that the schemes don't look great even on rolling return basis. So he can choose if he's really needing the tax savers in his portfolio. Otherwise, he should move out and have regular open-ended equity funds for his long-term equity portfolio.
Okay, thanks for the view there. Let's move on to the next query. We have Ronak, who's writing to us from Jaipur. He says that he's currently invested in mutual funds and has accumulated close to 21 lakh rupees, and this is via SIPs. Now, most of his SIP tenure are coming to an end, and he wants to continue investing. He's saying that his main objective is to create wealth with no near-term need of any cash and can invest till his retirement. So he's looking to invest 1 lakh rupees on a monthly basis. How should they go about this? Nirav, firstly, your view.
Yeah, so I'm assuming you already have a core portfolio, right? And for the investable surplus, a generally good way to go about it is to split the investment into a core and a satellite strategy. This gives you a lot of clarity in terms of how do you want to manage both sections of your investment. So one, you have a primary corpus. Now within this 1 lakh, you can create a core portfolio of around 60 to 70 odd percent, wherein you take exposure with a much more longer term view with flexible mandate funds, right? You can choose very good funds belonging to the flexi cap category, to the multi cap category. There are focused funds, value contra funds, right? So a combination of these funds in the core part of the portfolio would be a very good idea. And on the satellite part, you may want to take some amount of satellite bets. Like for instance, you can add in some amount of gold into your portfolio over a longer period. Gold has been known to add an effective hedge. It is a low correlation asset to equities. You must have some of that. If you have certain aspirations for yourself or for your family, wherein there are dollar-linked expenditures coming in, you can utilize the satellite portfolio to take exposure to global and foreign stocks. You can take slightly more aggressive bets where you may need to be more attentive into mid and small cap funds, wherein it is a much more highly aggressive bet. You need to be very selective with the funds, but the compounding effect would be much more stronger over here, right? So this is a primary approach you can take for your incremental 1 lakh rupee investment. That should hold you in good stead.
Absolutely. I think, they do have that core portfolio in place as well. Probably, they have some of these names like Axis Tax Saver, Kotak Emerging Equity Fund, there's a Flexi Cap Fund, they have Tata Digital India Fund as well they've invested in. So what are your thoughts coming in and what should the viewer do now?
Just a bit on his goal, Vinny. First, he's 32 and he's saying that he has a portfolio of 21 lakhs and looking to invest 1 lakh a month. So if he continues with that, and let's say he would retire at 55, then he would be able to create 17.5 crores with that, assuming only 12% ex-IRR. And if we are looking at a 60-year retirement age, let's say, which is a 28-year horizon for him, then he can create about 32 lakhs, which can be great. And if he and his wife together are able to do a bit of a step up, then they can create a very good portfolio, a good corpus for themselves for their retirement. Coming to the funds, he again has two tax savers. Of course, Quant has performed well. Axis, I think, can definitely move out. So can Quant if it is not required for tax saving purposes. He can have clarity in terms of, like Nirav mentioned, what should be the core and what should be the satellite. I would also suggest, since he has a 20-ish year horizon, I think some passives should be added. So I would recommend adding a large cap passive fund, which is the Nifty 50 equal weight strategy. Gold, I would agree, should be added to the portfolio. I think sectorals can be skipped at this point, especially something like a digital fund, which is a very small theme that he's taken exposure to. And I think if one of them has actively managed mid cap, then probably a passively managed mid cap can be there in the other portfolio. And I think both of them can have one flexi cap each.
Okay, that's a view coming in there. But on that note, we are going to actually sip into a very short break, viewers. Don't go anywhere. We still have a whole host of queries that you all have sent us, and we'll be doing just that and answering all of that after the break. Welcome back to MF Corner on CNBC TV18. Today we're solving all those mutual fund queries that you all have sent us, and to do just that, Prableen Bajpai as well as Nirav Karkera are here with us. Let's move on to the next query. We have Sailesh Singh, who's writing to us from Ahmedabad. He has been investing in a couple of funds through SIP, and one of them is a Mirai Asset Large Fund, large and mid cap fund. And since the performance of the fund has dropped in the last couple of years, he has stopped his investment and is planning to redeem and invest it in another fund. His current gain is around 4.5 lakh in this fund, and if he redeems the entire corpus, he will be charged that LTCG, that is there of 12.5%. So he wants to know how is it advisable to redeem the entire, is it advisable to redeem this entire corpus and pay LTCG or stagger the redemption over the next couple of years? Nirav, your view.
So one thing for sure, the fund has been, hitting a speed bump in terms of performance. Of course, the past 1 or 2 years has not been looking really great for the fund. So having said that, one thing to understand is every fund goes through cycles, right? The fund has a longer track record. It is definitely facing a few problems, but it is important to see if the speed bumps are due to fundamental changes in strategy. I feel the much bigger point to address here is, twofold. One is the taxation bit, and second is if he should move out of the fund as he's moving closer to retirement, right? So number one, talking on the tax bit, definitely 1.25 lakhs per annum is exempt. These qualify for LTCG, I'm assuming. So one, it definitely makes sense to stagger the withdrawal if possible through a couple of years so that the capital gain incidence is as minimal as possible. Two, the more important point is not choosing between this fund and another large and mid cap fund, but the fact that as you close towards retirement, you must slowly and gradually de-risk into non-equity assets or lower equity exposure assets, like possibly hybrid funds or a combination of debt funds, arbitrage funds, right? So the decision needs to be made at these two levels. So probably a staggered redemption to lower tax incidence and a subsequent reinvestment into lower equity exposure funds should hold you in good stead.
Okay. The next query for today is coming from Nag, who's writing to us from Hyderabad. He is planning to hold his mutual funds for 15 years and is expecting around 2.5 crore rupees for 15 years. He started investing in weekly SIPs from Jan 2025 and stopped it in April 2025. He's spoken about some of the funds he's holding as well. PPFS Flexi Cap, HDFC Flexi Cap, Nippon Large Cap is there, Motilal Oswal Mid Cap, and some of the other names are there. So he's asking if you could review the portfolio and suggest what levels could they add more small and mid cap funds, and could you also suggest if he can add any more mutual funds in the portfolio to reach that goal that they have of 2.5 crore rupees. Prableen.
Yeah. So, Vinny, to reach this goal of 2.5 crores in 15 years, if you're assuming 12% returns, firstly, what is the SIP required? That would be roughly 50,000 a month. So he hasn't mentioned what is he doing currently, but 50,000 is what is required on a monthly basis for his goal. Then, he's saying that he has stopped his SIP, which is just about 4 months after his starting. So the very idea of an SIP, I mean, it's the principle, the premise it's based on is rupee cost averaging. So that you don't need to time the market, you don't need to see the levels where and at what levels you're investing. Having said that, of course, if we feel that, let's say, mid or small caps have run up a lot, you can definitely reduce your exposure via SIPs, probably increase your exposure in large cap SIPs. But at the same time, you continue that monthly investment or probably whatever weekly he's doing. So if he's trying to time it, Vinny, it kind of defeats the very idea of doing an SIP. So I would firstly urge him to continue with his investments in a manner. He's got a 15-year horizon. There will be periods when large caps are overvalued, periods where mid and small caps are overvalued. So I think you should just continue with his investments in a planned manner. And just to give an example, over the last 10 years, if we see the mid-cap index alone gave us like the 20th till 20th June kind of period, if we see 2015 till now, it delivered 20.01% returns, XIR or SIP returns. And Vinny, during this period, the mid-cap index has fallen, in absolute terms by 44%, by 21%. Again, it has been fall since September 2024 till April. It fell by around 21% almost. So there have been so many periods where there have been these huge falls and then markets recover. So I think the very idea of trying to time can be futile. And what he should do is move in a with a set portfolio and in a disciplined manner. And definitely he should reduce his small caps from 3. If he wants to keep probably 2, although 1 is good enough. And the remaining funds look good for him.
Okay, thank you so much for helping with that. Next query for today, we have Balaji is writing to us from Tamil Nadu. He's invested 24,998 rupees in SBI Quant Fund regular plan, growth plan. And he says that the performance has not improved in the last few months. Wants to know if it's a good fund or should he exit. What should they be doing with this, Nirav, now?
So at the very outset, SBI Quant Fund is a part of, the quantitative strategy. There are very limited funds out there in the industry that follow a pure quant model. And SBI Quant Fund is one of those. It is the performance, the lackluster performance is not isolated to SBI Quant Fund. In fact, all the funds in the category have been really struggling to perform. I feel there is a longer journey before quant models really start performing. But that's a story for another day. Up immediately for Balaji, the idea is to, perhaps try and reallocate to much more effective categories, possibly ones that operate with a much more flexible mandate. There are very good flexi-cap funds available. There are very good multi-cap funds available. Some of the names in flexi-cap that you may want to explore include the likes of Parag Parikh flexi-cap or DSP flexi-cap fund. In fact, there are a few focused funds also. Now, considering you invested in a quant fund, you might be looking for slightly more aggressive strategies. So a 361 focused fund could be a good bet even there, right? So it does seem like a good idea to move out of quant funds because the models are also susceptible to underperformance during singular and narrow rallies in markets.
Okay. Next query for today coming from Sumit, who's saying that he wants to know if it's advisable to make an investment in balance advantage funds for a period of 4 years, next 4 years. And also, if yes, which fund should he look at right now? Prableen?
Definitely, Vinny. I think balanced advantage funds, and I'll also add multi-asset allocation funds, they can be quite ideal for an investment horizon of 4 to 5 years. And it's kind of the best of both worlds thing where they're trying to protect the downside while giving you decent returns when the market rallies. So in the September to April fall, when Nifty fell by about 15.5%, some of the good multi-asset and balanced advantage funds were able to contain the fall by just about 4%, 5%. Some of them fell by about 8%. And of course, there have been more, but then you have to look for the ones which are which we have been able to protect the downside over different calls. White Oak, multi-asset, Parak dynamic asset allocation, in fact, were like slightly in positive. ICICI multi-asset, SBI, HDFC, Nippon, I think some of the good fund houses from where he can look at these funds. So he should consider both balanced advantage and multi-asset and have expectations of around Nifty 50 returns over this time period.
Okay. Nirav, I know this is a long query, but one short query that is coming: best small cap fund to invest in for 10 years, because we're absolutely out of time and the viewer really wants the answer.
So I'll directly move to the best fund. So, we have our own Fisdom ratings. As per that, Edelweiss small cap and Bandhan small cap stack up across most parameters.
Okay. Thank you so much for that. Thank you so much, Prableen, as well as Nirav. There were a whole host of queries that are still left. But thank you so much, viewers, for sending us your queries as well. Keep sending them us. We'll take it once in a while as well. And thank you so much, Nirav, as well as Prableen, for joining in with us. But with that, we are out of time on this edition. Don't go anywhere. Up next, your closing bell.